May 25, 2026, SoftBank Group Corp. announces plans to raise yen 260 billion, roughly $1.6 billion through another sale of subordinated bonds. This time, the offering is aimed primarily at individual investors. This isn't SoftBank's first foray into the retail bond market. Just 2 months prior, the company executed a similar offering, demonstrating a clear pattern. This repeated appeal to individual investors signals a strategic shift in how SoftBank accesses capital. The timing is notable. SoftBank, under Masayoshi Son, has historically relied on institutional funding and its own venture capital prowess. However, recent market conditions and the performance of its Vision Fund have necessitated exploring alternative avenues. Subordinated bonds carry higher risk than senior debt, meaning they are paid back after other creditors in case of bankruptcy. This higher risk typically demands a higher interest rate, making them attractive to investors seeking yield in a competitive market. For SoftBank, tapping retail investors offers several advantages. It diversifies their funding base, potentially reducing reliance on large, single institutional investors who might demand more control or stricter terms. It also allows them to capture capital from a broader pool, especially in markets where individual savings rates are high. The $1.6 billion figure represents a significant amount of capital, underscoring the scale of SoftBank's ongoing financial operations and its need to continuously fund its ambitious projects and manage its existing portfolio. This is not pocket change. It's a substantial injection of liquidity. The market has seen robust demand for such offerings, with previous bond sales to retail investors being oversubscribed. This indicates a strong appetite among individuals for the yields these instruments can offer, even with the inherent risks. This strategy also allows SoftBank to raise capital without diluting equity or ceding significant control, a crucial consideration for a company built on its founder's vision and aggressive growth strategies. It's a way to fuel growth from the ground up. Want the next breakdown the moment it drops? Subscribe and follow. For individual investors, understanding the risk profile of subordinated bonds is paramount. Look for the yield premium. Is it sufficient to compensate for the increased risk of default compared to senior bonds from the same issuer? Always diversify. Don't concentrate a large portion of your portfolio in a single subordinated bond issue, even from a well-known company like SoftBank. Spread your risk across different asset classes and issuers. Before investing in any bond, consult the issuer's latest financial reports and credit ratings. Understand the company's overall debt structure and its ability to service its obligations, especially in challenging economic cycles. When a company like SoftBank turns to the retail market for billions, assess if their yield offer adequately compensates for the subordinated risk. If not, it might signal that even they perceive a higher risk than the headline number suggests.